Hey there, welcome back. I'm Tim Hill, a Canadian mortgage broker with over a dozen years of experience helping people navigate their home financing, even through tough times. Today, we're diving into a topic that hits close to home for many: how divorce affects your mortgage and real estate in Canada. If you're going through a separation or divorce, you might be wondering, what happens to the house? Can I keep it? How does this impact my mortgage? Don't worry, I've got you covered with practical advice to help you make informed decisions. Stick around for the next 20 minutes and we'll break it all down. If you find this helpful, hit that like button and subscribe for more mortgage tips. Divorce is already an emotional and stressful process, but when you throw a mortgage and real estate into the mix, it can get complicated fast. In Canada, your home is often your biggest asset, and your mortgage is likely your biggest debt. So, what happens when you split up? There are three main paths. One spouse buys out the other. You sell the home and split the proceeds, or you try to keep things as they are. Each option has unique implications for your mortgage, credit, and financial future. Let's dive into the details. First, let's talk about the mortgage itself. When you and your spouse signed that mortgage, you likely signed as co-borrowers, meaning you're both legally responsible for the debt, regardless of who's paying the bills. In a divorce, the separation agreement doesn't automatically change the mortgage contract. The lender still expects payments, and if they're missed, it can hurt both of your credit scores. This is why it's critical to address the mortgage early in the divorce process. As a mortgage broker, I've seen couples overlook this, only to face surprises later, like one spouse's missed payments tanking the other's credit. One common option is for one spouse to buy out the other's share of the home. Let's say you want to keep the family home for stability, especially if kids are involved. To do this, you'll need to buy out your ex's equity in the property. Here's how it works. First, get a professional appraisal to determine the home's current market value. Let's say your home is worth $600,000 and you have a $400,000 mortgage. That leaves $200,000 in equity, split 50-50, so you'd owe your ex $100,000 for their share. But here's the mortgage catch. You'll likely need to refinance the mortgage in your name alone to remove your ex from the loan. This means you'll need to qualify for a new mortgage based on your income, credit, and debt load. In Canada, lenders use the stress test, which ensures you can afford the mortgage, even if interest rates rise. If your income alone can't support the new mortgage, you might need to explore options like a co-signer or a smaller loan amount. I've helped clients navigate this by finding lenders with flexible terms, but it's not always easy, especially if your credit took a hit during the divorce. Another option is to sell the home and split the proceeds. This is often the cleanest way to separate financially, but it comes with its own challenges. First, you'll need to pay off the existing mortgage when the house sells. If your mortgage has a fixed term, you might face a prepayment penalty, which can be thousands of dollars, depending on your lender and remaining term. For example, breaking a 5-year fixed mortgage early could cost 2 to 3% of the loan balance. Once the mortgage is paid off, you and your ex split the remaining equity. But here's where real estate comes in. The Canadian housing market can be unpredictable. If you're in a hot market like Toronto or Vancouver, you might get a great sale price, but you'll also face high costs to re-enter the market later. Plus, selling means both of you need to find new places to live, which can strain your finances if you're taking on new mortgages or rent. As a broker, I always advise clients to factor in closing costs, like legal fees and realtor commissions, when calculating what they'll walk away with. Sometimes, couples decide to keep the home and mortgage as is, especially if they want to delay selling until the kids are older. This is less common, but it's an option. For example, one spouse might stay in the home and continue paying the mortgage while the other moves out. However, this doesn't remove the non-paying spouse from the mortgage contract. If payments are missed, both credit scores are at risk. To make this work, you'll need a rock-solid separation agreement, drafted by a lawyer, outlining who pays what and what happens if someone defaults. From a mortgage perspective, this option is risky because lenders don't care about your separation agreement. They care about getting paid. I have seen cases where one spouse stops contributing, leaving the other struggling to cover the mortgage alone. If you go this route, consider setting up a joint account for mortgage payments to keep things transparent. Divorce can wreak havoc on your credit and affordability, which directly impacts your ability to refinance or get a new mortgage. For example, if you're splitting debts, like credit cards or car loans, your debt-to-income ratio might increase, making it harder to qualify for a mortgage. Plus, legal fees, spousal support, or child support can eat into your income, reducing what you can borrow. As a mortgage broker, I recommend checking your credit score early in the divorce process. You can use free services like Borrowell or Credit Karma to monitor your score. If your ex misses a payment on a joint account, it could hurt your credit, so consider closing joint accounts or freezing them during the divorce. Also, update your income and expense details with your broker to get a clear picture of what you can afford post-divorce. All right, let's wrap up with some practical tips to help you navigate divorce and your mortgage. First, get professional advice. Work with a mortgage broker, lawyer, and financial planner to understand your options. A broker can shop around for lenders who specialize in post-divorce refinancing. Communicate with your lender. Let your lender know about the divorce early. They might offer temporary payment relief or restructuring options. Update your separation agreement. Make sure it clearly outlines who's responsible for the mortgage and how equity will be split. Consider timing. If you're selling, check the housing market trends in your area. If you're refinancing, lock in a rate before interest rates climb. And finally, protect your credit. Monitor joint accounts and pay bills on time to keep your credit score strong for future mortgage applications. Divorce is tough, and dealing with mortgages and real estate can feel overwhelming. But as a mortgage broker, I've seen clients come out stronger by making informed decisions. Take it one step at a time, lean on professionals for support, and focus on building a stable financial future. Whether you're keeping the home, selling it, or starting fresh, there's a path forward. That's it for today's video on how divorce impacts your mortgage and real estate in Canada. If you found this helpful, give it a thumbs up and don't forget to subscribe for more tips on navigating the Canadian mortgage world. Have a question about your specific situation? Drop it in the comments below or reach out to me directly. If you're going through a divorce and need mortgage advice, check out my website for more resources. Thanks for watching, and I'll see you in the next video.